Hey, what's going on, everyone? This is Tyler Coates, and today's video is not actually going to be listed on my YouTube channel. It is just going to be for those of you who have the EMASAR indicator. There was a big update that was recently published today that will require some significant explanation, so I figured that the best way to do that would be to just put together a video. Whether or not it'll be a quick video remains to be seen. There are a handful of very important topics that I'm going to be wanting to cover, and I will be taking as long as I need to take in order to cover all of the details there. So want to thank everybody, those of you that are tuning in, thank you very much for your support and for purchasing the indicator. Also thank you everyone who has provided some positive feedback. I really do appreciate that, hearing from those of you who have been using this indicator to make money from the markets in real time. That is really exciting to hear from those people, so thank you. And with today's update, there's a big change that I'm really excited about that will solve the single biggest problem that has been a problem with EMASAR that I really didn't even think a solution would ever be found. So I'm extremely excited that we've got a solution, and not only a working solution, but one that is working very well. And I'm really happy with how it has been working. So quick shout out to Johan Duplessis. He has been helping me to code this most recent update, and the help that he provided is a big part of the reason why this new update is available. Without his work, I can't imagine that we would have this available for you guys today. So thank you very much, Johan, and we will be continuing to work on this. Is just the first kind of part of a series of major updates that will be occurring, all of which I am just extremely excited about. So this will be a really great way to kick off the updates that will be coming here very soon to the indicator. Okay, so as you guys, what you're looking at right now, this is how you have known EMASAR all along. Very basic and straightforward signals that just tell you what to do and what price to do it at. Open long here, 81.59. Shortly after the close, short came in at 78.98. And then you hold on until close long, and then wait for the next signal, whether it be open short or open long. You just wait and see. And as we see, these signals have been working really well. This was released kind of back in here maybe, and we very well, just as easily could have started out with a handful of bad signals that were in a choppy environment that cost money. So it's really great and fortunate to be able to release this indicator before some trends followed and some good signals resulted. So the signals have been working exactly as intended. There was a little bit of issues right in the first week or two, but since iron out the kinks, the signals have been working exactly as intended, and I'm really happy with how that has continued to perform, not only in crypto but in traditional markets as well. Now, the single biggest problem with EMASAR is so significant that it almost caused me not to release the indicator, not to make it available to anyone really other than myself. And that issue is the inability for users to effectively estimate risk, and therefore to effectively calculate position size so that you're not risking more than a certain percentage of your bankroll, rule of thumb being around 2%. If you're wanting to make money from trading, the number one rule is going to be money management. And if you're wanting to effectively manage your risk by not risking more than 2% on any given trade, well, users haven't been able to do that with this system because you have no idea where the stop loss would occur. I have a very good idea just because through experience I can get a really good feel. For example, when this signal was occurring, I was estimating in the chat group about a 10 to 15% risk, and that is very, very common range for the 4 hour. So that is something that I have been able to get a very good feel for myself, and then therefore I entered something like 20% of my bankroll, and if it went against me, and I got stopped out, then I would have lost around 2%. But for individuals who are looking to execute these signals for themselves in real time, you just have absolutely no way to know what is your risk. And that is a huge problem. And like I said, it's almost enough for me to not make this available. I mean, it definitely does feel irresponsible to a degree to release something like this without an ability to effectively calculate risk for those of you that are using it. So in the end, I decided that if you stick to the signals and don't over leverage yourself, then where the signals come in should basically be a good way to manage risk, because it's telling you to basically bet with the trend. And I didn't think I was ever going to be able to figure out how to get an estimated stop loss that worked across all time frames. So that was kind of a dead end that I didn't think I would be able to resolve, and I am very, very happy to say that now we have a very, very good solution. So if you currently have EMASAR on your chart, I guess this is an old version. It should say EMASAR 1.1 was the most recent version that would show the moving averages. So yeah, this is an old version. But if you have the EMASAR indicator on your chart, it should either look like this or say EMASAR 1.1. What you're going to want to do is just go ahead and delete that, come into indicators, invite only, and just reload it. That's all we're doing, is taking the indicator off of the chart and reloading it. And when you do that, it will look completely different. We still see the same signals that should be all occurring at the exact same price. There shouldn't be anything that changes about the signals. But the two major things that will jump out at you is going to be this blue wavy thing that is under the price, which is the estimated stop loss zone. And it will be referred to as the ocean moving forward. So this title of this episode is EMASAR 1.2, the ocean, and that's what this is the estimated stop loss zone. And that's just a name that I have given it. So that is the first major, the biggest update that resolves the biggest problem that this had, and we will walk through how this can be used to estimate risk in real time. And then that allowed for us to add in this pop-up that will appear. If you have it selected, you can remove it from your chart by unselecting display position size if you decide you don't want it there anymore. Or if you are getting an entry signaled and you want to know, you don't even have to look at the ocean. You don't even have to look at the estimated stop because this has all the information right here, which is pretty darn cool, really. So in here, if, for example, we were looking to short, then this is going to tell us our risk and therefore our position size, which is going to be a function of the max that we want to risk. And now we can come in here to the inputs and adjust this. You can adjust your bankroll size, tell it exactly what your bankroll is, tell it exactly how much you're willing to risk. 2%, maybe it's 1%, maybe it's 3%. I think we capped it at, no, we didn't. It should be capped around 5%, I would say. So 2% risk, 10%, $10,000 in the bankroll. Now we click OK. Now we come in here and see that this is going to be estimating risk for a short position because we are on a short signal in a bear trend. It's not going to tell you any risk for a long position because EMASAR would not be telling you to long here. So it would only be estimating risk on a short. And now say that you got this short position, short signal right here. At that time, you would also have the yellow box pop up and tell you, okay, here's the estimated risk. Here's the position size, max position. This is a percentage of your bankroll, so that'd be 6.35% of $10,000, which gives us our position size of 635 bucks. If we enter 635 bucks and it moves against us, and we get out around our estimated risk, then we should expect to lose about 2% of our bankroll, or $200. So this isn't telling us that a signal is occurring here, but it's just going to be on every candle. It will just, every time a candle prints, follow to say, to illustrate, okay, here is what the position size would be based on if you were to currently enter short, then this is the position size that you should enter based on the parameters selected, which was 2% risk, $10,000 in the bankroll. So this isn't going to be, there isn't going to be a signal here unless price retests the 200 EMA. If we get a death cross and price retests the 200 EMA, that is our signal to either add or enter if we miss the first signal. So I would be looking for price to get up to around the $7,300 area to signal a short entry, and I would be looking to execute that. In the meantime, I don't want that box up telling me estimated position size for right here because this isn't an entry. I don't care what the estimated position size is here because it's not an entry. But if we get up to here, instead of manually going through and calculating the position size that I want to take, I could just come back here, throw that on, and it will tell me, you know, based on the price up here. If we get up there, then it will recalculate what the risk is and therefore what the position size is, and then I wouldn't have to do that by hand. Super, super handy, especially for shorter time frames or higher frequency stuff, or for people that flat out don't like math. Really neat to be able to have that and to adjust the parameters. Okay, so the only reason we can have that is because of how effective the ocean is at estimating stops. So basically, those that were following along know that I was buying this dip right here around 92 to 94, if I remember correctly. 93 to 94, I guess maybe I was on a different exchange. But I was buying this dip, and when we came down in here, this is where I became worried that now we're really in danger of getting stopped out. But what is also the case is that it's at a spot where it could just be a shakeout before the breakout. This area here between the ocean and the 200 EMA is where shakeouts happen. And that's why we don't want to be getting ourselves stopped out here preemptively. That's why I will never have a hard stop. Well, I won't say never, but 95% of the time I won't have a hard stop in this area for when price first comes down in here. If it quickly reacts, I mean, this will happen time and time again, where it head fakes below a horizontal. It causes stop losses to be executed by people with hard stops or liquidations or whatever the case may be. And then after dipping down in to test that, it skyrocket, you know, has a sharp reaction back above the moving averages before they cross over. That will happen time and time again. So when the price is in here, it's in a very trappy territory, and we need to be very careful not to be stopping ourselves out preemptively. And that is what the ocean does such a good job of illustrating. Once you enter it, you are really entering into deep, deep water, and that is part of the reason why it gets that name. Here we're in trappy territory, territory where it's actually an area where I'd be mostly interested in buying or adding in case that it is just a trap and we get a sharp reaction, and if to not be risking much at all. I'm going to be getting out at or near break even. So therefore, I can look to buy around the 200 EMA and add when it is between the 200 and the ocean. For longs, it would look like this. For shorts, it would be right here. And then if price enters the ocean, that's when you get into very deep water, and it starts to suggest that a reversal is imminent. There will be times where you get into the ocean and then have that sharp reaction, but once you enter the ocean, the most probable outcome starts to become an exit signal. And that is what this is kind of estimating. Is in here is our estimated risk, where we would expect stop losses to occur. So therefore, when I am buying in here, I can use of the ocean, which will otherwise be referred to as the buoys, the marker points of the estimated stop loss zone that is in the middle. This is where you become very, very probable to reverse the trend. If it doesn't find support above the buoys, then you are highly likely to get a moving average crossover, which will cause a close long signal. Okay, so there's a number of things, implications that can be drawn from that. First and foremost is just using it to estimate risk. Let's see right here. So if I'm buying this right in here, I want to figure out what is my risk. So I would just figure out what is the distance from here to the median. And that is my estimated risk on this long. Right here is 9%, 8.95%, because that is the distance from the entry. Remember, the entry is when price retests the 200. So that's the, and the estimated risk is the buoy that is directly below that candle. We could move that over just a little bit. So here's our entry. Here is the buoy, which is the median of the ocean. That is your estimated risk. If price gets there, we are highly likely to get stopped out, and we're also highly likely to be able to exit at a price around there. There are times where it'll just fall straight through and keep going, for sure, but that is the exception to the rule from what I have seen. If we do come down and break the buoy, that tells us that a reversal is imminent, and we still may elect to kind of hold on and wait for that moving average crossover. And if it happens, we should be able to get out at around that price, and I have seen this work very, very well. Here is a great example. If we were buying this 200 EMA, we would be wanting to estimate our risk by figuring out the difference between the entry and the buoy. That is 8.56%. Price falls there. We know that it is now highly likely to lead to a stop. We could exit here. I wouldn't myself. After a big sell-off, I'm more interested in, some sort of bounce to sell. But we can also, it tells us to be on guard for a moving average crossover, and it also helped us to effectively calculate risk and our position size and leverage as well, potentially. So here we see that estimated risk is 8.56. That tells us if price falls this far, we should expect it to lead to a stop. It won't always. It could fall this far and then take off, but we should expect it to lead to a stop if price falls this far, and we should expect to be able to get out at around that price. So here, 8.56, if we bought, price immediately moved against us, we could look to just go ahead and exit. Okay, we calculated our risk, here it is, so now we're just out, screw it. Don't want to, no ifs, ands, or buts about it. That could be your approach, to kind of have a hard stop here. I prefer the approach of waiting for confirmation from the moving average crossover and also looking for some sort of bounce. So here, we estimated our risk at 8.56%. Maybe that's exactly where you exited, or the signal came here at the close of this candle, which was at 8809. So it actually got you out at a slightly better price than what was estimated. And that's, we want this to be conservative. If anything, we want it to be estimating more risk opposed to less risk. So that's what we'll see, is that it has been very, very accurate. And in general, when it's wrong, it's on the conservative side. And if you really want to be conservative, you can use the bottom of the ocean as your estimated stop. If you really want to be conservative. I don't. I use the median, the buoys, but you can yourself if you decide that you just really prefer being conservative, or you trade with a lot of leverage and therefore you need to have some sort of buffer, but then you just use that as your stop, and that is the very conservative price. If you're using the bottom of the ocean as your stop, you should be highly confident that you'll be out at that price if it falls there. So yeah, here we go. We fell to that buoy, got the close long. I did miss that close long, kind of, but well, I saw it and price already kind of moved back down to what I was looking at as horizontal support. So I did wait for a return to the 50 EMA to go ahead and execute that. That's often I look for retest of the 50. So I didn't get out right here, but I did get out here. And then open short signal occurs. I missed that. I was on the plane, but let's just go through calculating that. So we get an open short signal here at 8227, occurs right here. So we check our estimated risk is 18.4%. And then we use that to calculate position size. Basically, we'll go through that quick. So 18% estimated risk. Let's start with bankroll. And this is what that the indicator will be doing for you if you have that yellow pop up. But it's good to know for yourself how it's being calculated. So you just need to know a couple variables, and you can figure out your position size. So you need to know your bankroll, max risk 2%/200, estimated risk. This was 18%. So in order to figure out the position size, now we just need to do what is estimated risk divided by max risk equals percentage of bankroll. So what do we have? We've got 18. And so for this, we use, instead of the percentage, a whole number. So 18 divided by 0.02 equals, and I did that backwards actually, 0.02 divided by 18. Gosh dang it, what is wrong? Yep. Sorry about this. Trying to do all my calculations live and just running into a bit of a brain cramp here. So if we have our estimated risk of 18%, then we need to know how much can we enter such that we do not risk more than 2%. And then we are going to be able to, gosh dang it, this is frustrating. This is a calculation I do every day, and I am going to figure it out. It's just going to take a second. Okay, so if we yep. So, okay. Sorry about that. Like I said, just a little bit of a brain cramp. So we do estimated risk divided by, still screwed up, max risk divided by estimated risk equals percentage of bankroll. Okay. So we see that what we're willing to risk is 0.02. And if we divide that by the estimated risk, 18%, so 0.02 is the percentage of our bankroll, 2% of our bankroll that we're willing to risk, divided by the estimated risk of 0.18 gives us 0.11. What 0.11 is the percentage of our bankroll. And we can double check that by looking at, okay, if we enter in $1,100 here and it goes against us and we get stopped out, then what do we expect to lose? We expect to lose 18%. So we would do 0.18 times 1,100 equals $198. And what is 2% of our bankroll? 200. So that calculation is correct. So I just had got a little confused there for a second. I got some numbers mixed up. That'll happen. But here is your calculation, and this is what that yellow box is going to estimate. So let's pull that back up real quickly. So basically here, this yellow box is going to tell you estimated risk 30.3. Let's just compare it to here. So it just shows you your bankroll is going to be adjusted in the settings. So here you put in the 10,000 bankroll. Here's where you put in your max risk of 2%. And then here it pulls the rest of the information. All it needs is the estimated risk here, the difference between the price and the buoy, and now it has all the information it needs. Once you have estimated risk, your bankroll, and the max risk, then you've got the information that you need to do max risk divided by estimated risk, and then it'll give you the percentage of your bankroll, and then it will also go ahead and convert that to a dollar amount. And you can double check that this thing is calculating properly by coming in here and looking at, okay, it's telling me the estimated risk is 30.22%. How far is price currently from the median? That's exactly right. So therefore, we can run these calculations by hand to double check and make sure these are all correct. And if we do that enough, we can just have a degree of confidence that it's correct after seeing the distance from here to the estimated risk is right, and therefore everything checks out. So here we were looking at this short entry here and using this distance from the median, and that told us that on a $10,000 bankroll we should be entering $1,100, and based on the estimated risk, if everything goes against us, we should lose about $198, which is about 2% of our bankroll. So that is how this is being calculated. That's what I do by hand all the time, and now it'll be nice to have that available. Okay, let's see. And something else that this can do for you is one of the best things about EMASAR, as far as I'm concerned, is its ability to keep you in, to recognize when kind of these shakeouts are happening, and to it's figuring out a stop loss system for crypto is the hardest part of trading crypto, as far as I'm concerned, due to the volatility, due to the manipulative nature, and due to the big traps and fake outs that occur. It can be really, really hard to figure out what sort of stop loss system you want to implement. If it's too tight, you're just consistently going to get chopped out and stopped out on traps before the market moves in your favor. And trading crypto with too tight of stop losses is a recipe to lose a bunch of money, bottom line. Trading crypto with too loose of stop losses is a recipe to potentially lose even more money. That's never been more clear than after this recent action, where price plummeted 50% in the matter of yeah, I don't have to tell you guys, you were all there. So seeing, you need to find that combination of a stop that isn't so wide that you find yourself holding onto bags as markets move really hard and fast against you, but it can't be so tight that you're getting, say, stopped out like here when it breaks down the horizontal to stop people out before taking off, or here where it breaks down the horizontal to stop people out before taking off. So you want to make sure that you're not getting stopped out too soon, so you can allow trends to keep moving in your favor. But you also want to make sure that you're getting stopped out in time, that you are protected from something like this. So that is the beauty of the stop loss system of EMASAR. The best part about it, as far as I'm concerned, is how it will allow you to hold on to positions while markets continue to move in your favor, and then it will get you out shortly after it reverses. It will keep you in during dips and get you out before reversals. Now, the issue is a lot of people, they don't like holding a position without a hard stop loss, and there's good reasons for that. Take, for example, Bitmex shutting down. If the exchange goes down and you get a close long signal, but you're not able to actually close your position because the exchange is down, that could be a huge risk, and you could end up getting the right signal but having to hold through, or getting completely wrecked on something like this because you simply didn't have access to an exchange, or something along those lines. So there's good reasons to argue that you always want a hard stop on the books, and that is where I find the balance gets really tricky in crypto. For me, not having a hard stop on the books is what really protects me from getting trapped in and out. But I can completely understand people that do not want to risk holding on to crypto positions without a hard stop loss on the books. And that's where you can use the top or the bottom of the ocean. For example, we could use the bottom of this ocean as an area for a hard stop, that if that gets triggered, we're just out. That's our hard stop market order. If price gets there, we're out. And if we get a close signal before that stop occurs, we can look to get out at a better price. So somebody that doesn't like trading with no hard stops could use the bottom of the ocean as a hard stop to trail this all the way up and then your hard stop would be right here. Price gets very, very close to triggering it. It doesn't, and you get the close long signal. So you either could get out here, or if you're really brave, wait for it return to the 200. So you kind of have a best of both worlds in the sense that you have a hard stop loss in place that you really don't expect to get triggered, but if it does, you know you're protected. And if it doesn't, you would expect to get out at a better price before that gets triggered. And this is a good example. When it gets close, doesn't trigger the hard stop, gets us out at a better price. Let's take a look here. This one would have potentially a hard stop, would have gotten you out right here on this top wick, but look at where the signal occurred, 78.98. So if you had a hard stop there, you really were only $100 away from where the actual signal occurred, and then you wouldn't have had to actually be awake to execute that. That just would have occurred for you. And just another really good example of price gets to the buoy, and a closed signal occurs, and a closed signal, this area was estimating ahead of time where a closed signal would be likely to occur and where you would be likely to get out. So right here, if you were using that to estimate your risk, that was almost perfect. Buoy was 78.56, stop came at 78.98. So very, very, very good there. And let's see. If you were using a hard stop, potentially that got wicked out at the top, but barely any different than where you'd want to get out, and that would protect you if, say, you were sleeping. You know, it would protect you from something like this. And a really good. When I saw this, I was really excited. Another unprecedented move was in October of 2019 when the price went from 7,400 up to 10.4. in a very short amount of time, record 24-hour pump. And look at where the estimated stop was for EMASAR. It was way up here this whole time, telling you that this trend wasn't in danger of reversing unless price got up into this area, like the mid 9,000s. And that was estimating that when we're way down here at 75. It was telling you that the estimated stop is up here at 95. And then sure enough, where did the stop occur? I mean, just right on that thing. Very, very, very impressive to have it working in such an unprecedented environment. Look at this. It gets right up to the top. Maybe that triggered a hard stop, potentially, right at the very worst price. But look at how, I mean, if you were just a tick or two above that, you would have been safe. And that's how we want this to work, is you have a hard stop right here that in these crazy sort of situations, you know that worst case scenario, this is where you're going to be exiting. But likely, if we rally up there and it doesn't trigger, now we're going to be able to get out at a little better price on the following correction. So that's just a beautiful example of estimating ahead of time where the stop loss is likely to occur and what price you would be able to get out at. It's not like it just took through and the stop occurred here, you know, with the price way up here. The price was still right around there when the stop occurred. So yeah, we can go through a number of these, but yeah, it's just been working really, really well. And it's something, like I said at the top, I didn't think I'd ever be able to get this figured out. I definitely didn't think I'd be able to get it figured out this well, and a big part of that was definitely due to Johan. So right here, this is kind of what we see, where it'll come down, it kind of supports around the buoy, and then it gets back above the 200. That's a strong sign of a bit of a shakeout before a market's ready to take off. When it fails to regain the 50 and comes back down in here, now closing along at 96.14, which is a little bit worse than where this buoy was. So definitely not going to be exactly precise, and please keep that in mind if you are trading on leverage and your liquidation is anywhere near this area. You're going to get liquidated. It's just a matter of time. So please understand that.
Here we get a close at a significantly better price. So this is, again, the whole ocean is the estimated stop loss zone. Anywhere in here is where the estimated stop loss is to occur, and the median does a very good job of, on average, what to expect. So here we do get that close significantly before getting up there, which would make the trade it would still cost you something, but it costs much less than originally expected, which is always nice. Okay, let's see. And yes, that is just one last thing to cover. That covered all the most important things. So let's do a quick recap. Quick recap would be, when you get a signal, use the buoy to determine your risk. Signal here, 81.59. So we would just determine the difference between the entry and the buoy, or the median of the ocean. And we see here 15%, which is exactly what I was estimating mentally when this signal occurred. I was typing in chat, looking at about a 10 to 15% estimated risk. And here now you can objectively recognize that yourself just by looking at what is the entry and what is the median of the ocean, aka the buoy, under the price. So right here, you don't need that price tool. You can just come in here and say, okay, here's the buoy, 68.65, entry 81.59, 81.59 minus 81.59 minus 68 minus 6.858. I'm done doing elementary math after this, I'll tell you that much. Divided by, so 81.59 minus 68.58 gives us $1,300. We divide that by the entry, 81.59. 15 point, gives us 0.15, which is 15.94% risk. So that would give you the exact, opposed to that this tool is a little bit of a estimation. So going through the recap, we get a signal, open long here at 81.59. We then identify what price is the buoy at. There will be only one when that signal occurs. And then we determine the difference between the signal and the buoy, or the median of the ocean, and that is our risk. We then use the risk to tell us how much of our bankroll we can enter. You can go back through that formula yourself by hand until you understand it very well, and I definitely recommend that. Or you can just turn on the display position size and make sure that bankroll and risk are set correctly. Okay, so now that we know our risk, we can use that to figure out our position size, or we can do that automatically. And then from there, we can use the bottom of the ocean to place a hard stop loss. If we are mostly comfortable when there is a hard stop to protect us, we can use the bottom of the ocean as that and use a stop market order, maybe a few ticks below, that would have to be continually adjusted. As this progresses, you would trail that stop loss, and you would keep trailing it. You would potentially look to add when price retests the 200 EMA. If you do, then you would just do the same thing, calculating what is the difference between the entry price and the buoy, and that is our risk. And then we use that to determine position size. And if we change our position, we need to change our stop loss accordingly. So you could be trailing with a hard stop. And then here we have our hard stop to protect us. Price comes down, it breaks the buoy. Tells us it's a high probability that a stop loss is going to occur, and when we are
ready for that is also helpful, opposed to just a signal kind of coming out of the blink of an eye that we weren't really expecting. That can cause us to have some, consternation, a little bit of anxiety, kind of maybe a little bit of deer in the headlights. But if we're expecting it, then we can just be here ready. Say, okay, this thing broke the buoy. If this doesn't instantly get back above the 200, we need to be ready for this closed long signal. And even though we have stop on the books, we are expecting to get out at a better price, and we are using the buoys and the ocean to help figure when that stop needs to be executed manually and to supersede the hard stop that is in place. So lots of things that can be done with the ocean. Again, mainly it's used to estimate risk and to determine position size, but also it can be used to implement hard stop loss and also to kind of just be prepared for maybe what is around the corner. Last update that is cool that I want to make sure to share is that for me, when I change the distance of my moving averages, often like for me, the length of my moving average is determined by the color that it is. So if I see a green moving average on a chart, for me it's a 50 EMA. My mind automatically assumes that because I use the same colors for various EMAs. If I see an orange line like this on my chart, I just know it's a 200 EMA. And I can get myself into trouble here where, say I want to check the 30 EMA, if I change that and I leave it green, then I screw myself up in the future because I just see a green moving average and I just assume that it's 50. So for me, it's really important to change the color for different period moving averages and to use a consistent set of colors so that I always know when I see pink, this kind of pink moving average, I always know it's around a 30. So what you notice there is that I just changed the short MA in the settings, and the moving average color automatically changed. So I would always know that if, say, I wanted to adjust the settings to use the 30 and the 200 instead of the 50 and the 200, I could adjust those settings and I'll never forget that I'm using the 30 and the 200 because now the color changes to the color I'm used to for that sort of term. I often will use something like a 9 and a 50 for different things. So I could go ahead and change those. And shoot, the 9 didn't get the right color that I wanted. So if you want to change the colors, you can come into here. You've got color 1, 2, 3, 4, 5, 6. We should probably highlight these a little better. So this is going to be moving average 1 to 5. This is going to be moving average 5 to 14, the color of it. So I just did a 9 period MA and I saw it wasn't the color I wanted. So I came into here to color 2 and changed it to this blue color that I always use for that sort of period. So now when I'm in here and I input 9 and 50, the colors automatically change so that I know. And of course the signals would automatically change as well. But this is just affecting the colors because for me it is a risk to adjust these and not realize that they were adjusted. So yeah, different colors for different ranges. Like the 1 through the 5 is just a similar range, so I want one color for all those. 5 through the 14 is a similar range, so all one color for those. And so on and so forth. Yep, I think that is going to do it. The last part, I will just give a little bit of a teaser for what is coming down the road. I mentioned that this is kind of the first part of a major update that is coming, and one that I am as excited about as I could possibly be. It is going to be a really, really big deal, and I think you guys are going to be tremendously excited about the final product that we are working on. I sure know that I am. So that's something that I haven't shared with anybody except for maybe like a few friends here and there, and now seems like a good time to go ahead and kind of tease where this thing is going. So in the future, what you're going to have, and not necessarily guaranteeing it will be at the same price, it almost certainly will be an option to add a trader mode to EMASAR. So right now what we were looking at, what you've known it as previously and what we were just looking at, that's the investor mode. It just gives you signals, buy here, sell here, and that's what it's for. It's mainly for investors. There aren't many signals at all. Like on the 4-hour, I get one signal every 6, and that is, kind of position trading, which is, AKA investing as far as I'm concerned, just another way to look at that. So the investor mode is the signals as you know them now with the stop loss and position size added. And the trader mode is what I am super excited about because it implements basically this is all that I need to trade. This is how I trade the EMASAR signals, and it is a really, really powerful illustration of how to kind of trade the moving averages opposed to more invest in them. And what we're looking at here is going to look really noisy and a lot going on, and that's why I'm excited to do it in pieces. But essentially, what we're looking at is when the blue ocean flips, from here it's below the price, telling us we're longing in a bull market, and when it flips to above the price, that is your signal. That's your signal in investor mode to go short, and that would be the signal right here to go short. But what this has is also the first signal that occurs when you get a flip. Now it has a trim zone and an add zone. So it shows, like right here is a really good example of where you get up into the ocean, but you quickly and turn it back into resistance. So that here is our sell zone. We're selling in here, and then this is our trim zone where we are looking to take some profits and re-enter and take some profits and maybe miss a re-entry. Here, take some profits, re-enter here, and actually I was incorrect. So that is just a basic overview of what you're looking at here. We're looking at gold right now on the 15-minute chart. It flipped, gave us our buy signal, has taken off. It's been above the trim zone, which is very, very important. It generally will be support when you're above the trim zone and resistance when you're below. So just wanted to give a brief introduction of what it's going to end up being, and that is the trader mode, where it will highlight exactly where I look to buy and exactly where I look to trim. And then the best part about this is it includes an exhaustion aspect. When it's yellow, it's a trim zone. When it turns orange, we're more looking to fully profit take, or we're wanting to be more aggressive with our profit take and less aggressive with our re-entries. We see that the red sell zone goes from deep red to lighter red, and this goes to orange, telling us we want to be more aggressive with our profit taking, less aggressive with our selling. And once it turns purple, it tells us to be on high alert for a reversal, and we actually want to look for a full stop and reversal when this turns purple. We can look to fully exit our shorts and not re-enter. Notice how now the sell zone disappeared. I mean, it's just incredible. It was this was our sell zone, but the exhaustion tells us that it is now no longer should be a sell zone. It is now exhausted. So that sell zone disappears, and the purple tells us that a reversal is probable, that we need to be on guard for a reversal in the near future, and therefore we would look to actually exit shorts and go long on the purple and not sell in this zone that was highlighted in red. And just see how beautifully that worked up in here. Turned purple, support disappears, and it just plummets right through.
I mean, as long as support was here, we were bouncing to the trim zone. Support disappears, and now this turns from a trim zone to a stop and reverse zone, and you plummet right through support and get yourself a sell at the exact perfect time if you were able to time that. So that is close to the final version of the trader mode of EMASAR, what will be EMASAR 1.3, and that's something that I've been just extremely excited about using myself. That EMASAR trader mode works on all time frames and all assets, and it is really, really powerful. So I can't wait to continue making updates and improvements to what already has been a great system for me, and now for some others as well. So really, really excited. The support that you guys have provided by purchasing the indicator has allowed me to invest into the development of this, and without you guys, I don't think I ever would have been, had any interest in really developing this thing out, because I was already able to identify these zones kind of mentally myself, so I really didn't have any interest in building this thing out. And now that I've started doing it, I've just been having a ton of fun, really, really enjoying myself, and getting really excited about the long-term potential. I mean, this is something that I think should get some interest outside of just the crypto sort of sphere. So yeah, thank you guys again for that support and for all of your contributions in the chat group. I've definitely been enjoying participating in the Eye of the Storm chat group. I think it's been a great place for people to start to get to know some other people, build some connections, and also learn. Been a lot of very good resources in there, good posts from a lot of people out there. So thank you guys for that. Again, before signing off, just to access the new version of the indicator, you want to close it. Close the one that you currently have, remove that from your chart, and just reload the indicator. It should then say EMASAR 1.2. And if you go into settings, it'll be clear that it's the new EMASAR, because it'll have the position size and the max risk and that sort of thing. And then any feedback that you can provide would be greatly appreciated, either in Telegram or via email. I don't really check comments on the YouTube, so if you could try to send any feedback via Telegram or email, I will receive that, and I will appreciate any input that you guys have. And yeah, so thanks again, and I will plan on catching up with you guys soon.